I want to transition here to credit. It kind of stays on the whole department store thing. So what do we have here? I'm going to slow down a little bit because I'm not as fluent in credit as Josh Steiner is, who is, I think, our amazing analyst who does this space. But this just shows your 100 largest banks out there and their charge-off rates over time back to 1986. And you could just see these massive spikes. You line them up with changes in the economy, and it's golden. I mean, it matches up really well. Where are we now? We're off here to the far right. We're at historical troughs. Charge-off rates have never, ever, ever been lower, or I guess haven't been lower prior to 1986. So I don't know if I had to say, are they going lower or higher? I'd probably say they're going higher. And let's see what we got here. Next page is we got some data from Capital One this past week, which is really closely linked with Kohl's. They've got a really good partnership there. And it was actually a decent data point. It wasn't bad. But the trend line over past 5 periods, it is actually still trending up. So overall, flatlined out there and starting to move up again. Don't really want to see a trend line doing that for anybody. Next page, I'll take these data points. I'll go even closer in. And on the far left here, you see basically that 30-year credit chart. So now let's go in and just explode like the past 3 years of that. And there are a lot of data points here. I only put in 3. One, back in November, you had a senior loan officer survey that just turned net tightening. Not good if you're any of these guys. 2, you had Macy's, who signaled an increase in their overall delinquency rate back in late February. That wasn't very good. And then just recently, earlier this week, you had Synchrony, and they basically guided down pretty materially because of an increased charge-off rate. So, I mean, look, you could say any one of these things won't just kill the credit cycle, but when you go years without seeing any of this, and then you just see one like every 2 or 3 months, it's just not good. So with that, let's look at who has exposure. Next page. Here are the credit, or here are the department stores and/or retailers who have the biggest credit exposure. It's not a great picture, and there's a few reasons why. One is credit. It says that if you're JCPenney, 6,100% of your EBIT comes from credit. Well, look, they lost money. The only reason why they actually made a little bit is because of credit. So it's like an infinite number. It's still a lot. You got Macy's at 38, Nordstrom at 31, Kohl's at 30, and I'd kind of stop there. There's a bunch going on with Signet, which I find really interesting. But overall, these are the companies I'm looking at, and it's just like really, really big numbers. And I think a lot of people forget what's happened over time. And if you look at what happened over time, and I'll use Macy's as a case study on this next page, the black line there, the column, it shows Macy's credit as a percent of sales. So basically, this is in 2008, so it's over the course of this past economic cycle, right? Downturn and then rebound. It went from 1% to a little over 3%. That might not sound like a lot, but that's huge. That's like, it went up by like a factor of 3. It's really, really big. And then you see the red line there is margins. Margins have gone right up from 6% up to 10. They've already started to trail down from 10 down to about a little less than 9 without even a hiccup yet in what's going on in their credit business. So we could see a meaningful hit in margins from here when there are people who are starting to ask us like, oh yeah, they could handle it. They're doing a really good job. They manage their business well, blah, blah, blah. No, sorry, they can't avoid it. Nor can Kohl's, nor can Nordstrom, and a couple of other companies on this list.